like to have a playbook. First off, jumping in front of earnings, that's a no-no, okay? That's like Russian roulette. Again, not if you have Microsoft for 9 years. I'm saying jumping in front of these earnings, they usually have a 6, 7, 8% move up or down. We don't know. But what we like to do in our kind of playbook, as you said, is actually find those companies that beat estimates, raise guidance, and then the analysts trip all over themselves. Okay, a lot of people don't like that. So wait a second, the stock is up 9 points, it's up 4%. They raise guidance. Yeah, you could jump on that train also. Again, the key is the analysts go from like hold to a strong buy, or they go from $110 price target to $140 price target. So again, stay away from the other ones that go the other way, Brad, which is, they miss numbers both times. Stock's down 20%, it looks cheap. I'm telling your viewers, that's quicksand. You'd rather go with those companies that beat and raise guidance, even if you have to pay up for it.
Even as we were discussing this earnings season during the last hour at the beginning of Catalysts, what we were hearing from one of our guests was expect fairly modest growth. There's a low bar to beat. And then additionally, you're going to hear a lot about CapEx here. So all of these things considered, it doesn't really sound sexy when for the last couple quarters we were talking about what are you guys doing with AI, and that is what companies were moving off of. So what is the common denominator that you're anticipating we could see this earnings season?
Look, I think there's still going to be some top line growth. I think there's investments that are going into AI, obviously, but now return on investments. I think, look, we're growth managers. We love NVIDIA, Microsoft, Apple, all those names, and most of those names are going to beat, raise guidance, probably buy back stock. But there's also companies like Walmart who are actually using this data, the great data dives, helping their logistics, helping their inventory, helping a whole bunch of factors that pretty soon we're going to transition from, okay, we know the picks and shovels very well. We know their names, right, Brad? But how about those companies that are using that technology and with that have more profitability because they have more data, which they go to the C-suite they pivot to area. That's where I think the next step of this AI is going to mature to, is the use of this technology and those companies really really doing a lot of good things with it.
And so how can investors out there who are trying to position themselves both going into and during earnings season, when they're hearing from executives, really tell the difference and set their strategy from a company that is fundamentally strong versus one that is jargony misleading?
Yeah, well, the market would tell you that a little bit too, right? And you see like companies like Nike, they miss their numbers, they miss their estimates going forward. Stock takes a hit. Intel's done it like the last 6 quarters. They're very consistent. They miss their numbers, they guide lower. So we know the ones to stay away from. But I have to tell you, a lot of individual investors, Brad, are going to go in there and try to buy those said companies that this earnings season that will be down 10 or 20%. We think that's a no-no. We want to buy those companies. Again, they're going to appear to be kind of expensive. They may take out the year high, but behind it is momentum. Behind it is still those analysts that's still playing catch up. So to us, it separates the men from the boys, so to speak. We'll see that this earnings season, as we'll see every other earnings season. But again, we like technology because they're more consistent. You mentioned before about small cap. We don't like small cap space. The Russell 2000, 40% of those companies are not profitable. We'd rather be with the market leaders where there should not be any surprises, or there's hopefully not going to be any big surprises.
It seems like for several quarters, there's been one key make or break name for earnings season, and that's been NVIDIA largely. Yeah. What is your earnings bellwether, one company or even one sector that could set the tone?
I think NVIDIA, again, they're a little bit off on their earnings, right? They come out the third week in November. They're not in the kind of, it's September end. But the CEO just said last Wednesday in an interview that the helmet's coming out as scheduled. Remember, that was a kind of little, not sure what's going to happen. And that the sales are insane. I don't know if you remember Crazy 80 commercial. You just go, our prices are insane. When a CEO tells you that sales are insane, you got to listen. You got to listen to these conference calls, these interviews. So I think from, we're in a second or third inning, maybe fourth inning of this AI move. And really the epicenter of all this is NVIDIA. And the CEO just said, and gave you a fat pitch, our sales are insane. Stock gained probably about 14, 15 points since last Wednesday. So I still consider NVIDIA to be a bellwether, though their earnings are a little bit funky. It comes in the third week of November.
Earnings growth rate anticipated by FactSet to be 4.4%. Do you believe that we'll hit that?
I think, look, a lot of companies do a good job guiding a little bit softer so they can get over that bar easier. I think those numbers are kind of soft. I think we expect higher numbers. And also on top of everything this earnings season, well, we have a Federal Reserve put, the POW put in place after 50 basis point in September, maybe another quarter in November, another quarter in December, and if needed be, there's that kind of sense, false sense or otherwise, but I don't think it's false sense, of this kind of circuit breaker, this cushion, the Fed has her back.
Ken Mahoney of Mahoney Asset Management. Thanks so much for taking the time here with
Thank
us.
you, Brad.
Certainly.
Ever wonder who profits off of out of control